Hello everyone and welcome to the Junior Market YouTube page. If you're tuning in from YouTube, make sure to check out our website. That's what we're going to be using a little bit today. And what the topic of today is 3 stocks that you need to look for before the election year. Now, if we go to the stock of the day page that I have on my website, we can see that I posted a new stock of the day, which is Comcast. Now, I do a full breakdown, full overview of all of the stock in this document, including the description, the opportunity, the 5-year forecast, all that type of stuff. But in this video, we're just going to be going over a brief overview of Comcast as well as 2 other stocks. So as we all know, today the Fed rate cut started and it's expected to continue throughout the year. So I plan to do a video on that as well, some stocks to pick up as rates continue to drop. So let's hop right into these. First off, as we all know, president elections coming, 2024, starting in the coming months. Now, what do we know about this? We know that the S&P 500 tends to rally during election years. So the theory that rotation into small caps might likely make more momentum. So small caps might be something to look into, like the Russell 2000. So the S&P 500 has returned an average of 9.1% in election years since 1950, compared to 8.3% in year 1 post-elections. So if we head on down a little bit more on Forbes, we can see that according to the U.S. Bank, the average return of the S&P 500 in the 12 months leading to a midterm election is 0.03%, which is way below the average. However, the 12-month period after the election, there's an average return of 16.3%. So we need to figure out a way to get into some of this. So if we head on down into the companies, I'm going to be going over one from this website, which is Abercrombie & Fitch. I'm going to be going over Comcast, and then I'm going to be going over one more industrial company that I found on another link. So let's dive right into that. So first, we're going to head into Comcast first. So looking at Comcast, I'm assuming everyone knows what Comcast is. They operate in the media and technology company. They own things like Peacock and different media streams. And if we head down into the year to date, we can see that they're down about 10%, which is good because that means you could be getting a company at a discount. They're down about 12% in the past year, and 5 years, they're down 11%. They've stayed pretty stagnant. So if we head down into their dividends, which is what we're going to look at first, so their dividend increases have been pretty great, So their dividend increases have been pretty great, anywhere from 9 to 8%, which is pretty nice. And then even the years where there are significant drops, they bring it right back up the year after. So if we go down, we can see that their payout ratio is about 32%. Now, I did a whole video on dividend metrics yesterday, 2 days ago, I believe. And their dividend coverage ratio is well above the 100% that we look for, which means they make a lot more in net income than they do pay out in dividends. And then their 10-year growth rate, you're looking at about 11.5%, 5 years, 8%, which is well above the inflation that we like to beat. So if we head back, we can head down into some of their expected earnings and their revenues. So looking at earnings per share, we can see that they've beat every quarter for the past few years, and they earn $1.06 non-GAAP per share. That is a decrease of about 2% over the prior year third quarter, but that's nothing too big to worry about. And if we head down, we can see, let's get rid of that. If we head down, we can look at their revenues. Their revenues have 5.2% annualized 5-year growth rate, and they are expected to rise in the next quarter. Same thing with cash flow, expected 5.2% annual growth rate, but it is forecasted to drop just a little bit, but that's fine. If you go over and read my report on this company, I go over all of the reasons for why this is. So finally, if we head down into metrics, let's just look at a few things compared to their competitors. So some of their competitors include Charter Communications, Omnicore, some of the other things that Charles Schwab has put on here. Now, they're obviously competing with other companies like Netflix as well, but those are not listed. So if we look at their margins, we can see that their margins are pretty much in line with competitors. The return on assets and return on equity right here are also in line with competitors, which it doesn't really matter the number. All of these numbers are industry specific unless there is a serious outlier. So their price to earnings is 10 and their forecasted is 9, which means their earnings are expected to rise. And then if we keep heading down, we can see that their sales growth over the past 5 years is about 5%. 1 year is 0.42, which I go over why, which that is something to look at. We would like to see higher sales growth. Their sales growth over what they've been doing with Peacock and some of their other streaming services might not be the best at where they're allocating their money and their capital to. And then if we keep going down, we can see that their margins are very healthy, all in the double digits. And then their current ratio is 0.66, which would be something to look for considering they have more debt than assets, but that looks like it's about the industry standard, so that's okay. And then if we head on over into Morningstar for Comcast, we can see that they have a fair value at $54 with a 1-star price of $72.90. And then if you head all the way down to the bottom, you can look at some insider trading, which I always find pretty helpful. And if we look here, we can see that pretty much all of this year, all of these directors have been picking up this stock. And they've been picking it up at the end of June, which it was a similar price that it is now. So that is something that we'd like to see, is insiders picking up this stock. So let me know what you think about this. Heading on into our next one, we are going to do Abercrombie and Fitch. So, there we go. So Abercrombie and Fitch is currently trading at 137. And they just had a huge stock sell-off, which is why there are these huge drops right here. Which, what I read on Morningstar was that there was no reason for this huge stock sell-off, which could indicate that this stock, there's nothing really wrong with it. People just sold off and then the stock dropped. So that could explain why the price forecast is 182, because there's really nothing wrong with it. There was just a huge drop-off for no reason. So now it's just on sale. And for the past year, we can see that it's up 158%. So they had a couple drop-offs during COVID when their stock fell significantly, when they had a couple problems with making clothing for XL and XXL, and they refused. And then now, with the same CEO, they rebranded and they're doing it now, so their stock has, as we can see, recovered. So they don't pay a dividend, but if we head down into their earnings, we can check it out. And we can see that their earnings have improved. They missed on the Q1 and Q2 in 2023, but since then, it's been growing at a great rate. And in 2025, the earnings are expected to dip a little bit, but then they're expected to recover and an increase of 29.13% over the prior year third quarter. And then if we head down into revenue and cash flow, we can see that they have a 3.6% annualized 5-year growth rate and a 13.5% annualized 5-year growth rate. So their cash flow significantly improved. Their cash flow is booming. Between Hollister and Abercrombie, they are making a lot of cash. And same with their revenues. Their revenues have stayed pretty stagnant, but they are expected to rise, which is something that we like to see. And then if we head down into the metrics and the peer comparisons, so some of the peer comparisons that Schwab put are AutoNation, Gap, companies like AutoNation and Gap. And then if we look at their return on assets and their return on equity, their return on equity is really good. Their return on assets is also good. So this company has some great return metrics, and then their price to earnings is currently sitting at 14.3. Their forecasted is 13.09, which means their earnings are expected to grow. That is what we like to see. And then if we head down, let's go to look at sales growth. So their 1-year sales growth is 21%, which is absolutely amazing. Significantly beats all their competitors. 5 years, about 3.5%, which we would like to see that number a little bit higher. But they did have some rough years, like I explained earlier, so that's nothing too bad. And then if we go down into their margins, they do have some great margins, like their gross profit and their operating, significantly above their competitors. net profit, cash flow, like they do have good margins. Their current ratio is well above 1, and then their quick ratio, which takes out inventory and prepaid expenses, is pretty much at 1, and it's also better than all their competitors, so that is something that we like to see. So if we head on over into Morningstar, we can see that their fair value is currently sitting at 166, which, like I said, I think has something to do with the huge stock sell-off. Their one-star price is 252, which is $120 upside, which is honestly insane. And then, like the last time, if we scroll down to the bottom, we can see some of their insider trading, just to get an insight as to what the chairman and the directors and all them think. So a bunch of that, there are a few sales, a few gifts, a lot of sales actually, and these all happened in September. So this could play into the fact that the stock is up, that this might be something to look into if the insiders are selling off, or it could just be because they wanted to buy something else. It could have no effect at all, but it is nice to know what insiders are looking at. So now heading on over into our final company, which is Incor Corp. They are a metal and mining company, and they're currently trading at $144. So if we head right there we go. So they're currently trading at 144, and over year to date, they are down 18% or $31. And then over the past 5 years, they're up 185%, but they have hit a little bit of a slump year to date, and over the past 6 months, down 24%. So that is something to look for. But I found on another website that this company, over the past 6 elections, has raised about 13% after every election consistently. So that is something to look at. These industrial companies, and they do pay a dividend, which we're going to take a look at. So their dividend has a pretty inconsistent increase, honestly, 1%, 6%, 17%, but that is over COVID. So if we go down, we can get a better insight. So their 5-year growth rate is 6, 3 years 8, 10 years 3, which all of that beats inflation, so that's fine. Their dividend coverage is way above the 100% that we don't want to see. We want to see that number way above 100%, and it is. And then their dividend currently sits at $2.16, and it has grown from $1.50 back in 2016. So that's something that we like. We also like that their company has been growing, not just their dividend. So that is important to look at. And then if we head down into their earnings per share, their earnings have been kind of all over the place. They kind of peaked during COVID, and then they really fell off, a decrease of 64% over the prior year third quarter. And their revenues have been pretty stagnant, 6.7% annualized 5-year growth rate, 3-year growth rate of 20%, but a 12% decrease in the 1 year. So if we keep heading down, we can get into cash flow, which, like everything else, has also been pretty stagnant, 13.7% annualized 5-year growth rate, but it has, as we can see, pretty much stayed still. And then if we head back, we can go check out some of the metrics compared to competitors. So some of the companies like Barrick Gold and Agnico Eagle Mines have pretty similar margins. Their return on assets, return on equity are pretty similar to everyone else, which is fine. Their forecasted earnings is well above their current earnings, which means their earnings are expected to drop. So that is something that we don't like to see. That is not a sign of undervaluation. And then if we head down into their sales minus 12%, like we saw last year, 6% over the past 5 years, which is fine. It's below the industry standard, but this is a materials and mining company, and those tend to stay more stable. And then if we go down into their margins are all pretty much in the double digits, in line with competitors. Nothing too special or too outlandish that we need to take a look at. The current ratio is about 3, which is significantly above the 1 that we look for. They have a lot more assets than liabilities. Their quick ratio is also well above 1, which we like, but this looks like it's also an industry standard, so this is not something that's out of the ordinary or a value or a sign of undervaluation. So if we head on over onto Morningstar now, NUE, we can see that their fair value is currently sitting at about $180 with a 1-star price of $237 and a 5-star of $136, which is only a drop off of about $7. So that's something that we like. That is a sign of undervaluation. Now if we head on down, we can look at some of the insiders. So first up is a lot of acquisitions. We can see 4 acquisitions, 1 disposition, but a lot of acquisitions, and these are in June, so that is about the same stock price that it is now. So these insiders are picking up, and they think obviously what Forbes seems to think and what other online websites seem to think is that this company has potential after the elections. So thank you so much for watching. Those are the 3 stocks that I think you should look into before this election. And once again, to reiterate, go check out the stock of the day on our website. I just went over Comcast, a full breakdown, everything you would need to know before you invest in this business. Thank you so much for watching, and have a good day.